Hi, everyone. I've been kindly told this morning that I'm just the bait, but you guys are really here to make some deals in the booth. So I won't take too long. I'm here for half an hour. As I said, maybe I will share with you our take at Allianz for 20 minutes, and then we have a Q&A session. The reason why I'm super excited to be here is Allianz has become a major shaper of the real asset space. You know, our assets under management, our own assets. So what Allianz Investment Management manages is has grown from 51 billion in 2013 to 210 billion in the real asset space, you know, because of the low interest rate environment. So of course now a lot of people are asking what happens now that the low interest rate environment is behind us. And this talk about de-risking, and I wanted to hear a bit more. That's why I came to IBEM. I wanted to understand a bit more what was happening because, and I will have 5 messages for you today. 2 are short term. Antoine mentioned these accidents, or what he mentioned accidents, and then 3 are more long term, and I think they are important for, you know, who you are in the private equity space. 2022, you know, there was no place to hide. I mean, the LBO market really, you know, 20% less deals, 40% less value of the deals. I think the financing conditions has been really an issue. So I want to focus a bit on this as my 2 short-term issues: recession and inflation, but more interestingly, the interest rate environment. Where will central banks stop? So that would be my two topics. I call that the great complication. So the lower growth, higher prices, higher interest rate environment. And then I want to talk about something that is dear to my heart, which I think is what, you know, the environment in which we operate, which is a war economics environment. And I will talk to you about the 3 features of war economics. So that's my second part of this speech. First, on the environment, I'm still convinced there's going to be a recession in the US. I'm still convinced it's going to be mild. I think the Fed is hiking the US into a recession. This is the game. You know, in 2020, we stopped the world, put a lot of money into the system, hoped it will hold and gel. It worked, but, you know, this created massive inflation. And so now it's the Fed's job to make sure that inflation is under control. I think the reluctance from the Fed to hike before and maybe more abruptly has caused the Fed to be, you know, in the making, doing a policy mistake. What I mean by this is that I think the Fed will have to hike the US into a recession. That's the only way they're going to regain some form of credibility. And that's very cynical of us to think about this, but I do believe that we have the recipe for disaster right here. You know, we have the US financial conditions have really dried up. And it won't be something that will be transitory or temporary like inflation. And so this is very important to understand how this financial vortex in dollar terms is creating rippling effects in the private equity world. And we've seen that already in 22. I think we're going to continue to see that in 23, especially as default rates actually go higher or go slightly higher, and they've already started to go higher. So I call that a triaging recession. Triaging because it is really differentiating between the good, the bad, and the ugly. I think there is still a lot of dry powder in the private equity world. You know, the latest estimates talk about 800 billion of cash to be deployed in the second half of, you know, as clarity or forward visibility on what central banks will do will become, you know, something that helps, you know, some of these deals happen again. So we have, you know, this unfortunate or hostile environment. Not bad, but creating a bit of triage, a bit of Darwinism. And we have these financial conditions that are going to stay tight for quite some time. The good news is that it's going to stop at one point. We expect the Fed, even though they're going to increase by 25 basis points now, to stop somewhere around 5%, maybe 5.5%. That's high, but that's not unusual. At least historically, this is not something that is creating an unwanted wave of defaults, but that is creating a very different backdrop for LBOs, and this is also creating a very different backdrop for the relative decisions of investors. As a major LP, Allianz is indeed going back to the bond market because there are opportunities to go back to the bond market. We're also looking at less volatility in the equity market once we have clarity on what central banks are doing. So this is creating an arbitrage that is a bit different from the past 10 years, where there's been a massive, you know, centrifugal force towards or from listed markets to your world. I think this is really behind us, and this is something that is going to stay with us for quite some time. So short term, yes, I think there's going to be a recession in the US. I think in Europe, they don't want to call it a recession. The sound is really high now. But you know, the only reason why we avoid a recession in Europe is because governments are going to spend us out of recession. You know, in Davos, you know, Scholz said we're going to have no recession in Germany. Macron or Le Maire said we're going to have no recession in France. What they don't say is how do you avoid a recession? You just spend more. So the private sector is going to be in contraction, but the public sector is going to be actually patching things up, and we're going to be growing maybe 0.1, 0.2, 0.3. For me, there is no difference between minus 0.3 or plus 0.3. What matters is that we have not a lot of growth in the pipeline. And again, in Europe, that does mean we're going to have triaging. That does mean we're going to have a little bit more difficulty, you know, with the entropy, I would say, in the corporate debt world. We see insolvencies, for example, going back to pre-crisis level across countries. You know, so it started in Spain. It's very visible in Italy. It's starting also to increase in France and now in Germany. So we have this environment which is a bit different, but not completely unmanageable, and that calls for resilience. That calls for buffers. That calls for strategies to hedge a bit what has been unhedged before. I think that's the short-term environment. The main thing that I would say on the short-term environment is watch China in 23. The reopening of China is going to bring more growth and a lot bit more inflation. So the big risk here is that central banks actually have to do a bit more than they have planned or that market are pricing, because China is creating, you know, a bit of inflation, sucking up gas and oil. I think there is a form of respite right now, which is really bizarre. I sometimes feel we're a bit in the eye of the storm. You know, we have, after the winter, we're like, whew, we made it, you know. But there is next winter, and there is the winter after that, and we really haven't expanded our renewable energy capacity, for example, in Europe. So there is a bit of, you know, slightly better mood on the market since the beginning of the year. We've had record, you know, increase of debt issuance in the investment grade space. We had the equity markets go up by 10%. This is great, but just mind how this is going to play out through the year. Q2, Chinese reopening, rebound of inflation. Q3, you know, you always believe more in Santa Claus in October than in February, right? So when we're going to go back into the fall, people are going to start talking again about blackouts. And so we're going to have, again, negative confidence effect. So I call that the energy quarantine. This is not bad, but that just means that we're going to have ups and downs a lot this year and maybe into 24. One last point I wanted to make on the cyclical outlook, which I think is important, is once the US pivots, so when the Fed pivots, the US is going to go from a mild recession to a recovery. I don't see that play out in Europe, because the inflation is mostly energy related. So the only way to calm it down is not to hike ourselves into recession. It's just to do whatever we can to increase energy capacity. And that's why they've started with price controls. But that does mean that Europe is in a bit is in a purgatory. This energy quarantine in Europe will not make us go much deep, but we won't have a second half like the US was going to be much better, because we still have this lead on our energy supply that is not solved by next winter. So that's going to be a big difference between the US and Europe. So for example, the euro-dollar slight relief that we've seen since the beginning of the year is good news. But I would say that the dollar could actually come back stronger towards the second half of the year, when growth prospects in the US will actually increase, and Europe will be a bit stuck with managing next winter. So that's this transatlantic spread is something that is also important, I think, for the private equity world. So that's the short-term outlook. Now I want to project you to what I think are the big lessons of the past 3 years that are really changing the markets in which we operate. I call that war economics. And for me, war economics has 3 features: the great intervention, the great fragmentation, I know it was the theme of Davos, and the great widening. What I mean by this is, be it the war against the virus, 2020, the war against Putin, which is quite a virus in 22, and the war against climate change, which is the silent war ahead of us, I think governments, central banks, you know, private actors are entering in an area where we manage that a bit differently than we have in the past 20 years. The first thing is this great intervention. We've never seen policymakers overstay their welcome like in the past 3 years. We threw a lot of money at fighting COVID. We throw again a lot of money at fighting Putin. The cost of the war has been sponged up in Europe by very strong public expenditures. In the past 6 months, Europe has spent 250 billion, 5 points of GDP, to offset the cost of the war and to avoid people going and grilling sausages on roundabouts in France. Go figure, you know, the pension reform will still make the Gilets jaunes come back. But this is something to understand, right? We've never seen such a strong intervention, illiberal, you know, push from the policymakers, the public policymakers, into the real economy as we've seen in the past 3 years. Why is this important? Because I don't think this will go away. I think our leaders, our authorities really have a taste for interventionism that is not fading away. And I think we need to understand that investors have to, you know, sometimes people talk about the return of political risk. I think this is much more complex than this. This is, when I do forecasts, I do ex-ante forecast, which is what my model tell me, and then I say, what do I think crazy policymakers will do? And then this is my ex-post forecast. And go figure, the ex-post forecast is always crazier than what I thought they would have done, even in my wildest dreams. This is a new world. This is good and bad for your world. This is good because there is a ton of money that is still going to be spent on what they believe is critical. Critical infrastructure, critical cyber, critical, everything has become critical. So there is still a lot of public money, which is usually quite a bonanza for the private equity world. The bad news is it usually comes with a regulatory backlash. You've seen what's happening on the CFOs, so the collateral fund obligation. I think we have to expect that the private equity world is going to be under a bit of scrutiny and duress when it comes to regulatory environment. I also think that this regulatory backlash is going to affect LPs massively. So this is a bit the good and the bad of this great intervention. A bit more public money, the idea that we can avoid to have big bankruptcies, because we don't want to have unemployment, because we spent so much money to save the world in 2020. We spent again so much money to save the world in 22, that why would we ruin it all in 23 and have all these companies go out, go down, go belly up, and all these people go to the street, right? So that's good. For me, I think that's bad, because I believe that's going to be a problem with innovation. It's going to be a problem with crowding out some spaces that good companies could occupy. And I also think it's bad because the interest rate environment has changed. And I give this number because we're in France, so that you have an idea. In 2021, the debt servicing cost for France was 31 billion, 1.3% of GDP. In 2022, the debt servicing cost of France was 54 billion, 2.3 percentage point of GDP. Because we spent a lot of money trying to avoid that people go to the roundabouts, but also because we had a 300 basis points interest rate shock. So the great intervention, you know, the policy mix is different. This time, central bank don't want to save the world. Policymakers, you know, Bruno Le Maire is saving the world, one check at a time. It's also the same in the US. It's the same almost everywhere. In Germany, which is spending. We've been asking Germany to spend more for 15 years. They finally do it. So now people are upset because they do it with 400 billion off-balance sheet financing, but they're doing it, yeah. This is a world that is changing a bit your world. There is a bullwhip effect in the private equity world. Second war economics feature, the great fragmentation. I believe, you know, Trump started trade war, you know, the world managed trade war. Then we decided to deglobalize Russia. We managed that. It's not, you know, having a lot of consequences, but it has longer term consequences on the way we see the world. And for example, the financial sanctions against Russia are a good warning call against financial sanctions that could be applied to China. Because, you know, before Russia, we really applied these financial sanctions only to Iran. Russia is much bigger, not systemic, but much bigger. Whatever would happen between China and Taiwan could cause a revival of an idea that is putting financial sanctions against China. And this would be a bit more costly to the world. This would be costly to the world of financing. This would be costly to, you know, insurers, bankers, private equity companies that have had the world as a playground for the past 20 years and that are realizing now that globalization is not as frictionless as before. I don't think this is bad. I just think this is more costly. For example, I think even when central banks are going to kill inflation, which they're going to manage to do, hiking the way they do, there's still going to be a bit of residual inflation from fragmentation, just like there's going to be some residual inflation from decarbonation. So we need to keep that in mind because this is a different environment for financiers. Financiers have always had the luxury of having very liquid capital. There are frictions, But taxation on capital has been very low because there was, the myth that capital could move geographies when people couldn't move geographies. The result of that is social protection is underfinanced, right? Because we've put a lot of the financing onto labor, and so that's why you have pension reforms. This is changing. I think so far there is a put, no tax increase, maybe in the UK, but there is a put that there's going to be no tax increase. I think this is going to change. Because if you really go local, you have to offset the cost of being a bit more local than before. And so that means you need to recharge your tax income. So you have to keep that in mind, that the great fragmentation is, of course, this idea that you cannot operate as seamlessly between the US and Europe. Look at the IRA and the counter-IRA that Europe is trying to do. There is a lot of this idea that cooperation is going to be a bit more alpha male than the past 20 years. Yeah. But this has also consequences on a bunch of other things which are important to you. Tax attractiveness, energy attractiveness, regulatory attractiveness, all of that is about to change. We already see the energy attractiveness causing some firms to locate the units of production on one side or not of the ocean. It's going to be the same with tax, it's going to be the same with regulatory environment, because this is part of the weaponization of finance. That is a lesson from the war against Russia, because we decided to use finance instead of using energy or to use trade. The third point is the great widening. I think it's very important to understand that the responses to the war against the virus, against Putin, and tomorrow against climate change is creating a magnifying glance on inequalities. So what you see in France with the social unrest about the pension reform, it's not because the French don't want to work more. It's just because they don't understand why we need to save 14 billion a year when we just spend 25 billion capping electricity prices. Just a question of quantums between what we spend money without even thinking about it and where we ask people to make efforts when it comes to spending money a bit differently. This is going to create, this is not the first, neither the last time we're going to see the consequences of war economics in terms of social cohesion. You are all here in your industries, people do remote work. White-collar jobs, you can work from anywhere. This is great. Blue-collar jobs cannot do this. Can you imagine the unequal situation we're creating in the world between those that are tied to their location of work and those that are not tied to their location of work? If I take the purchasing power effect of COVID, inflation, and now recession, inflation twice as much between the first quintile and the second and the last quintile of growth. Recession, the jobs that you lose first are retail, construction, transport. You don't lose white-collar job, immediately. The wealth inequalities that have been creating because of what we decided to do has been very good for you so far, because we have decided to save capital instead of saving wage earners. I don't think this is sustainable. I think the wage war is coming. I think people are asking for their due after having seen a lot of the intervention over the past 3 years benefit, I would say 10, 20, 30% of the population instead of the rest. And this is something that is creating, I think, a lot of tension among policymakers because they don't know how to do differently. They don't know how to focus their support to the energy crisis so that not everybody gets a check. Those that have been accruing profits shouldn't get a check to offset their energy bill. They don't know how to force the firm to do more value sharing because it's called a tax and you don't want to tax higher. They don't know how to make sure that the jobs that are more resilient are in the blue-collar space when they are related to their location of work, and the war is on when it comes to competitiveness of Asian hubs compared to Central and Eastern Europe hubs, for example. Reshoring, which was the big word of 2022, is dead because you won't reshore from Indonesia, where there is free supply of gas, to Czech Republic or Slovak Republic, where they have no energy source but Russian imports of gas, So there is a new conundrum that is really palpable, and I think that has been in your world, that this wage war is going to be very important because people are going to ask for a bit more of the cake. And this is, you guys have been taking a big part of the cake so far. So I will stop here. I will thank you very much, and then I will take any questions you may have so that we are on time for the next. Thank you very much. Any question? The first one is the toughest one. And you can find all of that on allianz.com.
So we are seeing some layoffs in the US tech firms. Are we good to find? Are we good to see that in Europe?
The tech layoff in the US, right? So in Europe, usually when there is a downturn, people adjust the time you work instead of adjusting the headcounts. So I think we will first see an adjustment of the time of work, so using more interim solutions, using more reduction of labor worked. In the particular sector of tech, I think the cash burn in the US has been much higher than the cash burn in Europe tech companies. And I would say the pressure because of valuation differences between the US and Europe has been different. So I think what you see in the US is certainly coming to Europe, but I would say in a more muted way. I think in Europe, the problem is rather how do you make sure you continue to attract talent? I was mentioning IRA just before, the Inflation Reduction Act in the US. We can talk about whether IRA is good or bad or what Europe can do. I think the big question we should all ask in this room is the green brain drain. The big concern we should have is that even if the US are doing layoffs now in the tech sector, when they reopen, all the talents from the world still go to the Silicon Valley. It's going to be the same with the green brain drain for IRA. So I'm not, of course, the tech layoff in the US is a symptom, I would say, of the non-profit tech correction, the repricing in real assets, the idea that the recession is looming, and so there's going to be this Darwinism. I don't think we're going to see things like that in Europe because there's been more cautious embedded. I just invite you to look at CapEx growth in Europe and in the US in 2021 and 22, by the way, but 21 is really, I think, the reason why we won't see that. CapEx growth in Europe plus 18%, non-energy. Huh? CapEx growth in the US 43%. So the US was really overheating. So now they're cleansing. In Europe, we've been very cautious so far. But we need to keep in mind that this could happen. And more importantly, we need to keep in mind that we need to retain talent. I think that's the bigger problem for us rather than what, in the US, to be fair, some people have been documenting this. When you look at the jobs creating in the US, the job openings, that went from 600K to 400K to 200K now, a lot of that has been in the tech sector. So there were very few people that were coming from unemployment to employment in the US. There were more reshuffling, especially in the tech sector where people were changing jobs a lot. This is basically coming to an end. I think in Europe, we didn't really have this big turnaround on the tech job. We had a bit of talent war, but not like that. So I wouldn't be as worried. And if ever it comes to us, we need to retain talent, whatever it costs, that's for sure. I have the impression to be at the White House during a press conference.
Yeah.
Yes.
So
the guy in the gray suit.
Black question. So I think the elephant in the room question is not the level of the rate level, but how long will it stay at 5% or 3+% for Europe? And obviously that leads to a second question, which is, what's the nature of inflation today? Is it because of the fragmentation thing, or is it because of the pure monetary supply that was injected? And how fast will the Fed and ECB withdraw the massive thing? Because if 5% of interest rate stays long, then the arbitrage between private equity and bonds probably will push a lot of money out of private equity to bonds. If the arbitrage is just a 1 year off to kind of kill inflation, then the arbitrage will die and rate will go down. So how long?
I'm on the latter. I think it's going to be, I think the Fed, for example, is going to go to 5% and then pause for 9 months also. They're going to pivot early in 24, something like that. So I think by March, they will reach whatever they think terminal rates, and then they will keep it. I think the idea, if you will, is the terminal rates is going to be decided more or less by the jobs market. And then the pivot is going to be decided on year-on-year inflation growth, right? So by, I would say, December, inflation in the US should be around 2%, 2.3%. And so that means by early 24, they can pivot. I don't think 75 basis points or so. So it still means that we are at 4+%, right? So your point on the arbitrage, I think it's the monetary and financial conditions are going to be much tighter than the past 10 years. Yeah. I don't think there is an accruing effect on the arbitrage between private markets and the bond markets. I think people that want to go back to the bond markets have started already because 22 was such a repricing year. And if you are in the hold to maturity camp, it's a good time to re-enter bond markets, you know. But it's true. I would say what is true is I think the Fed will not go back below the so-called equilibrium rates in the foreseeable future. I don't think they will go back to 2% interest rate, key interest rate by end 24 or even 25 for now. So even though they don't stay at 5 and they go back maybe to 4, maybe to 3.5, it's still a very different environment that is creating arbitrage, right? In Europe, it's different. I think you know, you ask about the sources of inflation. In the US, I would say 2/3 of inflation is overheating. So it has to be killed by the central bank because it was helicopter money, it was about checks, and there is no such thing as a vacuum cleaner. You know, there is helicopter money, but there is no vacuum cleaning for money. So you have to wait, and quantitative tightening will help, that's for sure. Europe, totally different game. I think Europe, 2/3 of the inflation is basically supply shock, negative supply shocks. So that, you know, this is not, the ECB can do some, but we're gonna have a much more complicated, I would say, environment to hike above 3%, 3.5%. And secondly, I don't know if we can do QT. So the balance sheet cleaning in Europe is going to be more complicated. Why? Because if you really believe you're at war with climate change, maybe central banks will have to increase interest rates in the short run, but keep intervening on the longer end of the curve, so debt monetization, to finance renewable energy projects. So a bit of a Japanification. That's the story for Europe, because we didn't really have overheating. We had certainly some intervention, but we didn't have, for example, we don't see a wage price loop in Europe. Most of the wage increase is actually saved by people. So there is no wage price loop. As I said, most of the profit increase didn't materialize in investment increase like in the US. So even if the ECB increases interest rate, that won't solve the sources of inflation, which is, you know, whatever happens on energy, the broken power market, and also the energy substitution efforts that we're trying to do. So Europe is a bit of a more difficult issue because they may run the risk to go higher to manage the fact that some countries have double the inflation rate than others, but it will show monetary policy ineffectiveness, because even if you increase rates, you have more recession, but you don't kill inflation from energy. Whereas in the US, it's more textbook, I would say. One or two more questions, sir?
I think the main worry about the US is China. Do you have an outlook on China? Because of the size of the economy in China and the size of the population and the fact that it is a dictatorship creates is a big
I think the good news with China is that they do what they say and they say what they do. That's one of the perks of a dictatorship. You know? So China, we expected China to grow 4% because of this, you know, Sophie's choice between health and economics that we had in 21. They faced it basically end of last year. I think now, because they chose to reopen, you know, and they may have as much as 1 million deaths. That's the numbers that are circulating. I think we are revising our forecast for China to 5.3%. So almost, you know, more than 1 full point of growth additional from the reopening after New Year's Eve. I'm sure the government will say that they will do 5.5% because they also, and so they will do what they say and say what they do. So I think there's going to be, just like in 22, we had the rippling effect of the US financial vortex. So basically capital going back to the US, drying up financing and creating these tighter monetary and financial conditions. I think 23, at least the first half, we're going to see the effect of the big Chinese reopening. And so this is going to create a bit more growth. So maybe avoid some recession, like in Germany or something. But this is going to create a bit more inflation. So what I'm more worried about is the supply chain inflation that could be caused from the reopening of China, because right now, you've seen energy prices go down the first part of January. People think this is the new normal. I don't think so. So I'm a bit worried about the Chinese reopening creating inflation. And on the midterm outlook, I think China basically has been operating war economics, so state capitalism, for the past 20 years, so they know this game much better than us. I think their difficulty is going to be in the coming, the next 3 to 5 years, is going to be to make sure that they continue to be a partner of choice for a series of countries in Asia, in Europe, maybe in Latin America, that counterbalance a bit what the US are trying to impose on them. And I think they will succeed. I believe we, collectively, as investors, for example, we have been very naive about the ability of China to do what they say and say what they do. And so the Chinese dividend on capital markets is often not priced. So I would say there could be positive news coming from China compared to the negative news flow we hear or we've been hearing for the past 3 months. So I think I'm more optimistic, I would say, on the Chinese outlook going forward. I don't believe there's going to be a war, for example, with Taiwan. And I don't believe that China is as independent as they may say. They need the rest of the world to consume what they produce, and they're ready to move up the value chain. They're ready to play a bit more the attractiveness card. So for example, I think what has been happening, or at least the reaction, the epidemic reaction to Nancy Pelosi's visit to Taiwan, is a good example of the fact that the world has not really, written off China yet from the investing space. This is an interesting, this value versus interest discussion, I think is going to be with us for the next 5 years. But, it's very hard to say, okay, China is bad or Russia is bad, and then we procure gas from Qatar or we procure gas or oil from Azerbaijan. I think the world of supply is a bit more nuanced than what we sometimes see as a reflection of our own interests in these countries. Yeah. I think I have to stop here. Thank you very much, everybody, and have a wonderful IPEM.